Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. The day never ends, and Bruce Kasman and Michael Feroli ruined it at J.P. Morgan because they published their must-read weekly prospects. It's 7:05 p.m. Friday night.
Yeah, thank you.
I've read about 85% of Feroli that I've read in a bar.
Right, exactly.
You know, it's the way it is.
Yep.
And they're making multiple further progress towards this Friday where they'll publish the weekly progress. Joining us now from J.P. Morgan, Michael Feroli. Michael, what in God's name is multiple further progress? And what do you write about Friday in your weekly prospects?
Well, it's hard to say. I think you're referring to the FOMC statement yesterday, and I think that was probably influenced in part by what we saw yesterday morning with the CPI report, and that's probably going to be a big part of what we write about tomorrow.
So, Tom, does Michael Feroli, does he get an office at the new J.P. Morgan building on Park Avenue?
They get a floor.
He gets a floor? Okay. I
don't
know if it's a cubicle
they're
or an
above the
office.
gold vault, though.
Okay.
You know,
exactly.
The diamond vault. Okay.
The vault,
Continue.
exactly. Hey, Michael, what did you take from Fed Chairman Jay Powell's comments yesterday? It kind of feels like he's in a pretty good position. He doesn't need to rush into anything. What did you take away from it?
Yeah, I do think he's pretty satisfied with where things are going, and I think he's probably satisfied that he's taken a pretty calm approach both to the favorable inflation surprises we got in the second half of last year, the less favorable surprises we got in the first quarter of this year, and I think he's kept a pretty good eye on the horizon rather than getting too swung around here. But I think he's happy with the progress on inflation, labor market. I think. I think over the last several press conferences he has, and the market, I think, agrees, came out quite dovish. Yesterday, I thought he had struck the same tone that you kind of picked up in the statement and in the dots and so forth. So I thought he was much more balanced yesterday. But the one area where he sounded dovish was, I think, on the labor market.
Right now, folks, for Global Wall Street, the single question to Michael Feroli of the Booth School of Chicago and J.P. Morgan. Michael, you stopped time a long time ago with a potential GDP of America that was sub 2%. If we impute a higher R-star, if we settle for something above 2.x%, as Richard Clarett and others talk about, if we model in a new inflation, what does that do to your potential GDP estimate? Does it lift?
So I'm not really yet on the higher trend growth story. I do see, obviously, so first of all, I guess we can divide trend growth into trend labor force growth and trend productivity growth. I think clearly labor force growth has been stronger in recent years, given the immigration story. How much of that is sustained after the election and on into next year, I think is more of a question. I think on productivity, it's still hard for me to be a big believer in that, in part because when you look at the capital deepening numbers, which is essentially investment after depreciation, they really haven't changed much since the slow growth decade we had last decade. So once that, if that changes, I'll be more of a believer. But I think, what we saw in the first quarter was kind of, to me, a return to earth after what was a pretty good second half last year for productivity. But without those investment numbers, I'm still kind of thinking we're in the slow growth trend here.
Michael, what's your view on inflation here? We had the beginning in the first quarter, the first 3 months, kind of a pickup in inflation activity. It kind of caused some people to really step back here and think about the moderation call on inflation. How do you think about it here as this Fed tries to get to its 2% target?
I still think the moderation is in place. And when I look at I think in particular, when you look at nominal wage growth, wage inflation, and I know the links between wage and price inflation are very contentious, but I think in the long run, no one disputes that there's got to be some linkage there, right? And what you've seen for production workers is that wage inflation, after peaking around 7%, has come down to around 4%. Now, I know May was a little stronger for average hourly inflation, but I think when you look at, you kind of look impressionistically at average hourly earnings, Atlanta Fed wage tracker, ECI, ECEC, all these things kind of suggest moderation in wage inflation, which is ongoing. And I think as long as that is in place, I think the price inflation story to me looks like it's in place. But again, these are stories I think you have to kind of zoom back at and look at a quarterly frequency. But I think the story to me looks,
Right.
pretty intact when I look at the fundamental driver there.
Michael, thank you so much, particularly those discussions of potential GDP, a key part of JP Morgan research. Dr. Feroli working at Bruce Kasman.
Stuart Kaiser, U.S. equity trading strategy at Citi Global Markets, 390 Greenwich Street in Lower Manhattan, the worst elevators on global Wall Street. Stuart, what did you think yesterday from the CPI print, from Federal Reserve in the afternoon? What did you guys on a trading desk at Citi think about all that?
Yeah, good morning, guys. I would say, look, the CPI print was unequivocally positive news, right? I mean, the print was low. The mix within the CPI data was positive. Markets responded. I think, as you might have expected, lower quality stocks did well. Stuff that had been sort of under pressure from a higher for longer narrative, rallied pretty well. And then you got the Fed. I think the Fed is sort of the mirror image of what they did back in March, which was back in March, you would have expected them to have a slightly more hawkish narrative just based on the incoming data. And they sort of tacked a little bit dovish, particularly Powell in the press conference. And I think the effort back then was to keep the market centered and not let it drift kind of too far in either direction from the base case. And I think that's really what we got yesterday in the opposite direction. You would have thought with the strong payrolls and then the friendly CPI, the Fed would have, maybe been a little bit more positive in message and a little more dovish, and Powell, I think, sounded a little hawkish. And I think that was an intentional effort to keep the market kind of centered on the base case outlook.
Does this feel like a market that just wants to move higher, given everything else that's out there, just wants to move higher? I'm quoting Alex Steele, Tom. She came up with, I think, the best call I've ever heard, which is the market feels like it just wants to go higher. Yeah,
I think it does. I think, look, you have, an economy that for now is holding in solidly. Yep. You've got double-digit EPS growth. And I think those two things, generally speaking, you'd want high, or you would expect higher equity markets in that environment. And I think that's just sort of the situation we're in. That's our view. I mean, our base case view is higher until and unless the labor market really comes under significant pressure. So, we're going to remain constructive.
In honor of you, it's so intimidating when Stuart Kaiser walks in. I mean, Lisa, we got to go mathy here. We got to go log Euclidean math.
Boy.
Okay, run semi-log NASDAQ, the Stuart Kaiser chart. I ran it back to November of 2018. Ben Laidler, his shingles out at HSBC at the time, and he says, there's something going on, shut up and buy. And what's important here, folks, log regression, we're barely out over one standard deviation on the trend. We're not extended in this bull market. I don't think a lot of people know that.
Yeah, and I think to your point, Tom, especially if you look at the earnings growth we're generating. I know a lot of people are concerned with the large cap tech and growth rally, but why are those stocks outperforming? Because they're the unique companies that are generating this massive kind of EPS growth, both realized and in the forecast. So, when folks push back about us being more positive, we're just sort of anchoring back to fundamentals.
People
right now.
think they're extended. I mean, I get it. NVIDIA, and Lisa owns it, we don't. Fine, but the answer is, the NASDAQ 100, the math doesn't show Robert Schiller exuberance like, what he wrote about at Yale years ago. It's not there. Do you see exuberance in the NASDAQ?
No, look, I mean, I'm sure there's a stock here or there, yes. But, if you look to your point, big picture, this is not tech bubble type valuations, right? This is not, tech bubble type over your skis. This is a small number of companies generating a massive amount of earnings growth that are getting rewarded for it. So, are we above average valuation? Yes. I think if you looked at the S&P 500, you'd say you're probably maybe even upper quartile, upper decile. But, there's still room to expand, I think, if the economy holds in and we continue to print the type of earnings growth we are.
Stuart, I just got in my inbox, from Torsten Slok, our good friend over at Apollo Global Management. He's just basically calling out kind of what we know, but he's putting some numbers on it, which is, boy, the big cap stocks are just really richly valued. Small cap stocks, relatively cheap here, but I'm not sure I rotate out of the big caps and try to look for value here. How do you guys think of it when you talk to your clients? I mean, I think I just kind of own the big caps and go to the Jersey Shore and wait for September.
Look, we liked the broadening theme to start off the year because we actually thought earnings growth was going to broaden out. I think that's worked probably for a total of 4 weeks this year. Yep. Where the broadening trade has kind of worked. Why is small cap not working? I think it's because that's the part of the market that's most susceptible if you get a recession and is most susceptible to kind of higher for longer.
Right. Yep.
So people have been very cautious, to get into that space. And look, large cap is big earnings, introducing dividends, et cetera.
This strange word profit. Megdon Desai at LSE, it's his most important word. Profit. Let's bring it over to something bow tie like free cash flow. Do you see margin compression or the gloom of a lesser free cash flow out there for, say, 30% of the universe well-run companies?
No, not yet. And I think if you were to identify the one fundamental risk to equities this year, it was going to be, what does the margin outlook look like, right? If you look at the past 4 to 6 quarters, you've had very high nominal GDP growth and companies were able to protect
what do your
margin.
Security analysts, not you, what do your security analysts at Citigroup say to that?
Look, I think for now they're comfortable with the margin outlook. Scott Croner, who's our U.S. equity strategist, about $245 S&P earnings.
I knew when he had a real job. Being sales manager for the West Coast.
Now he's got 3 real jobs, so
okay.
He's even more popular. But he was high end of the street for a while on EPS, basically on this logic, Tom, and he remains there. So they're of the view that it is still a relatively robust fundamental environment for U.S. corporates.
What is owning 25 Delta calls on either the SPX or IWM? What does that mean?
It just means you own some out of the money upside in U.S. equities, and basically we don't have very many rules of thumb, but for a while you could pay less than the 10 implied volatility on that S&P 500 call option, which is just a really attractive entry to kind of rent to call.
Okay, so is that like betting on the Edmonton Oilers?
Yeah, I guess it is.
It's like equivalent to saying the Oilers can win one.
Yeah. Well, okay. I mean, win one. Yes, win one. Maybe not the whole series, but
folks,
get a game.
Go to Bloomberg, type in your stock, NVDA or NASDAQ index, whatever, OVDV, and that will give you the delta and the gamma. It's got all the volatility there.
All right.
XYZ. Good morning, Bruto de Pierre and the late Peter Carr who put that together for us. You can sell terminals with OVDV.
You're darn right you can. Yep.
I mean, I have no idea what I'm looking at. I'm looking at Swissy Hungarian forint, and you throw up an OVD volatility surface, and it's like, whoa, very cool. Stuart Kaiser, honored. Come back when the market goes down. He's with Citigroup, I should say, head of U.S. equity trading strategy as well. Matt Luzzetti, I don't have a revision yet on weekly claims. We'll get it here in a moment. I'll interrupt when we get there. But come on. The disinflation vector is in place. We saw it yesterday at 8:30. We see it this morning at 8:30.
Yeah, I would highlight both data points. Initial jobless claims jumping up to 240,000 is an important data point. Now, there's volatility in the week-to-week data, but if that were to stick, that's
What's
an
your
important
4-week moving average on claims where it's a whole new world after all?
I think if you are 240 to 250,
really that tight?
That is usually the numbers that you would begin to think about. I mean, initial jobless claims, when they move up in a sustainable way, typically stick there. Now, there's volatility in the week-to-week data. We had a jump a few weeks back up to 230,000. You have to look at what's going on in the state level data. So I don't want to, without seeing all the details, it's hard to know. But if that sticks, that's an important data point because the labor market has been strong because layoffs have been low.
Right.
If that changes, it changes the picture of the labor market. I'm not saying this morning's data point did that. But it certainly could be important if it sticks.
Well, all the Sweeney offspring are employed, so we're doing our part here. What'd you take out of the the Federal Reserve's chairman's comments yesterday, and just kind of the data we saw.
Yeah, so yesterday's morning CPI was a great data point from their perspective. It showed a softening, 16 basis points month on month. It was good in a lot of the areas that they would want it to be good. Services inflation was softer. Rent and OER was a little bit disappointing. I was surprised that they only showed one rate cut for this year. Okay. Now it is our baseline that they only cut rates once.
So you think that only once, and we do that in December?
Okay. In December. But I was still surprised that they signaled that yesterday. I thought that they would want to maintain more actively optionality to cut rates before the meeting. Now, Chair Powell downplayed the signal from that dot plot, as he typically does. But at the same time, I don't think he was as dovish as he could have been. He talked very strongly about the economy, about the labor market, about wage growth being high.
Come on. You're at UCLA with a wonderful faculty there, and all the heritage of Alan Meltzer being there. And come on, no textbook. Obstfeld, Rogoff, all the rest of them has multiple further progress in it. What a bunch of malarkey. I mean, I'm sorry. There's like 3 adverbs back to back. Who invented multiple further progress?
Look, the reality is we had 4 stronger prints to start this year. We did get 1 much better print. Mm-hmm. But the Fed, looking at the economy, the labor market report that we got on Friday, Atlanta Fed GDP tracking above 3% in Q2, is looking at an economy that does not urgently need
So
rate
then why
cuts.
doesn't he come out like in the old days and say, we don't know, we're data dependent, the market's got to pop, the economy's got to pop, the stock market's got to pop, we're going to wait, instead of all this mumbo jumbo?
So I think he did. The problem is that they have the dot plot now. And so if you just took the press conference in isolation, he essentially said that. We are data dependent. We're making decisions on a meeting by meeting basis. We have to see how the inflation and labor market data come in. We think the economy is strong right now, so we don't urgently need to cut rates. Now, the issue is they have the dot plot. Greenspan did not have the dot plot, and so it's harder to get away from any calendar-based guidance.
Can you imagine Luzzetti and Folkerts, Landau, and Hooper in a room together talking about the dot plot?
Yeah, how exciting
they probably have to switch to German. They get so obsessed.
Riveting.
Exactly. All right, initial jobless claims today, again, as Tom mentioned, they came in at 242,000. Consensus was for 225,000, so a little bit higher than what we've typically seen here was 229,000 last period. But I don't know. It seems like the consumer's in good shape. The consumer has a job. They're getting wage increases. They're spending money. How do you feel about the consumer these days?
So I think there's been a lot of questions about the consumer. You have kind of idiosyncratic reports from companies. You did have a weak consumer spending report if you look 2 weeks back. Now it comes off of consumer strength. But I would agree with you. There's this circularity between thinking about the labor market and the consumer. As long as the labor market remains resilient and strong and job gains are solid and wage growth is there's very little reason to think that the aggregate consumer weakens. Now, there is greater heterogeneity. You do have, at the lower end of the income distribution, there does seem to be some evidence of strains that are there. From my perspective, that's a little bit more returning to what the pre-COVID economy looked like than something that is signaling a worrying slowdown on behalf of the consumer.
Is inflation, we think about inflation because the Fed thinks about inflation here, and we think about a 2% inflation rate is kind of a target. Is that something this economy can get down to, or it just feels like we're kind of stuck here at this, I don't know, a high 2s or a 3% kind of inflation rate? Are we stuck there for a while, do you think?
I don't think so. I mean, this year, from a year-over-year rate, we will be stuck there. I mean, you have base effects that are difficult. Our inflation for core PC at the end of the year is 2.7, a little bit below what the Fed was. But as you look ahead to next year, I would expect shelter inflation is coming off. It does lag a bit, but that we can get closer to 2%. It's probably difficult to get into the low 2s without shelter inflation coming off more materially. But I think importantly for the Fed, they've been clear. They don't need to get down to 2% to begin to cut rates. They just need to have confidence that they're on the path to get there.
For our listeners or viewers on YouTube, what impacts their life with the first or even the second rate cut? What changes?
Look, the reality is these rate cuts are priced. So they are there in 2-year yields. They are there in 10-year yields. They are there in mortgage rates.
What about,
and so you need surprises.
Lisa Mateo at Costco.
Yes.
I'm serious. What's it mean?
So I think in terms of Costco, it's actually the reverse causality, meaning if Costco is cutting prices, then the Fed can cut rates.
We go to economist Lisa Mateo right now. Lisa, is Costco cutting prices?
They are not. They do have some good sale items, but no, the prices haven't come
This
down
is
very
important.
much.
Sale items. There's going to be a lot more sale items.
Yeah, and I think if you look at the CPI report yesterday, there was reasonably broad-based deceleration. Look at the trim mean was weaker. The median has come down pretty materially. So you did have broad-based softening in yesterday's inflation report.
We're going to run the studio conversations when we're on break for all of you worldwide and nationwide. Some people say they're smarter than what we actually talk about. I walk in and all Luzzetti and Sweeney are talking about is UCLA gets $72 million for playing Rutgers in field hockey?
It's going to be crazy. So, I mean, Matt, I know you're a Villanova undergrad, but you got your PhD at UCLA.
Transatlantic.
But now, your UCLA is going to have to come all the way to the East Coast to play Big Ten?
It is wild. I mean, thinking about the Pac-10 or Pac-12 and that disbanding and
the whole Stanford UCLA thing's gone, right?
It is. It's disappointing to see that loss, kind of that history and that legacy loss.
I think this is a big problem for the NCAA long term. That's just my opinion, because I think not the only thing, but one of the big things that college athletics had going forward was the rivalry.
So what's it mean for March Madness? I mean, that's what counts. I mean, Luzzetti, he's got 6,000 square feet.
Villanova and Duke, we'll be there. We'll be fine.
Bracket.
Villanova and Duke, but for everybody else.
No, but what's it mean if the Big Ten is sea to shining sea? That's what we're talking about.
I don't know. It's going to be, I think the ACC the same way. ACC has Stanford now in it.
What's it mean for UCLA, USC? I mean, that kind of rivalry.
I think that, very close rivalry does not change.
Right.
But when you think about, the other rivals within the Pac-10, Pac-12, those certainly become weakened, I think.
Focus Landau's listening to this in Frankfurt going, what in God's name
what is my chief U.S. economist talking about?
Matt Luzzetti, thank you so much with Deutsche Bank. I really want to resell here the idea that Matt Luzzetti was out there and said, you know what, we're going to see a slower economy. We did. Yep. But he had the courage and literally his first essay to say, stop guessing when the recession's coming. It's a fool's game. I am happy. I get to talk to Wendy Schiller with Paul Sweeney. She's at Brown University because she owns the high ground and the linkage of our history into where we are. As I walked into the building this morning, got off Sikorsky, came down the elevator. Sure. As I walked into the building, I stared at the G7 photo shoot, and Ed Duffner said, Tom, it's the Potsdam Conference. Oh. Wendy Schiller, what a train wreck of a photo shoot at the G7. 1945, Potsdam, Roosevelt dies, Truman shows up, different guy. While they're there, Churchill's thrown out of office, Clement Attlee becomes a prime minister, and Stalin's fading, smiling all the way. Wendy Schiller, I saw the guy from Germany going, I think I'm still in power. Macron hasn't slept in a week. The president has his own challenges. Trudeau's, I don't know what Trudeau's doing. It's a disaster. And that's what Trump would say. He said, it's a disaster in Canada. And on the back end of it is Rishi Sunak, who stiffed D-Day. What a mess. Have you ever seen a G7 like this, Wendy Schiller?
I have not. And the irony is that we're not facing a global economic crisis. So, a lot of these leaders, a lot of the parties, whether they're conservative or more moderate, business friendly, they're facing populist sort of anger and gains. I mean, really in the EU elections, and certainly look at Italy, look at Hungary, look all over the place. And you see that it's not connected as much to economic discontent as it was, as we might have expected it to be 10 years ago. So then that's a bigger puzzle, and that's what brings back World War II. Right. So what are these deep strains or trends in Europe? Certainly anti-migrant is one of them. But if the economy is getting better, and clearly the United States is leading there, but nonetheless getting better, yet all these sort of moderate, quote unquote, liberal democracy, these leaders are fading.
Right.
That's a big puzzle for us.
Off of the debate at Chicago, at Milwaukee, after Labor Day, are we going to see the same populist angst in America?
Well, so I think the trends are actually working against that to some extent in terms of the economy, right? So we have a little bit of a tick of unemployment, but we had a really good jobs report, and inflation, depending on who you talk to, seems to be at least calming down. So if consumer sentiment starts to rise just a little bit over the summer, folks can take a vacation, they feel comfortable about that, they have a good summer, they're feeling better about the economy, then I think things kind of moderate a little bit on these big pushbacks in terms of the far right. But Trump is courting big business. He's being very strategic about it. He said, listen, don't worry about me. I'm just going to do taxes, lower them, keep them low, and I'm going to get rid of regulation. I'm going to make you happy. I'm not going to do anything scary. And that's going to be his message today in Washington. And that's the big problem for the Biden administration is what do you do with that messaging? And how does Trump keep that far right wing of his party calm enough not to scare a lot of the independent voters away again in 2024?
Wendy, what do we know about those independent voters, those centrist type of voters? I guess by and large, they broke for President Biden last time around. They broke for the Democratic Party in some of the congressional election cycles. What do we know about that group here, which will be critical for the presidential election coming up later this year?
The only recent information we have is after the Trump 34 felony convictions. Some polling indicated that some percentage of those independents were less likely to vote for Trump. But you're looking at a body that's probably not likely to vote for Trump anyway. What's interesting is the polling coming out of Senate Democratic incumbents in swing states. They're actually doing better than Biden. And they're doing better than the Republican opponents or, supposed Republican opponents. So how are the Democratic incumbent senators holding on in swing states and Biden is behind Trump or tied with Trump? So that suggests some independents may be recalibrating, thinking, hey, we'll vote for Trump, keep our low taxes, but we'll vote for Senate Democrats to control Donald Trump and not give the Republicans a trifecta. It seems like there could be more split ticket voting this time around.
Okay, let's talk about that because it's not really in the zeitgeist, yes, but you just mentioned it. Could we see a GOP trifecta?
Well, that's the thing that I'm watching in terms of these Senate races, particularly Wisconsin, Arizona. Pennsylvania's a little bit dodgy. There's an open seat in Michigan. But thinking about those races and thinking about even Sherrod Brown in Ohio is up by 4 or 5 points against Bernie Moreno. Trump will win Ohio, I think. So that's going to be an interesting thing. I mean, I think the House is totally up for grabs, right? It's an 8-seat race. Right. There may be 30 competitive seats and 8 can switch and then one party can take over with a narrow majority. So we don't know about the House, but the Senate is supposed to be in Republicans' favor, just doing the math. But right now it looks like the Democrats are holding their own. And that's going to be what I'm watching going forward.
Wendy, this isn't why we booked you. There's Route 146, which comes out of Providence, a land of decent pizza, up to a suburb called Boston. And in between is Foxborough. Did you attend the Tom Brady Hall of Fame soiree at Gillette Stadium, Professor Schiller?
I did not. I hearken from the New York, Long Island area, and I am a Giants fan.
Well, you could have worn your Giants jersey. I mean, you could.
No, I did that at a Super Bowl party when the Giants beat the Patriots, and it wasn't popular.
Oh, there we go. Got that in. Professor Schiller, go away. Thank you. At Brown University, truly with their leadership in international relations. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.